Thank you everyone for joining in relatively early on a Saturday morning. So the last 6 months have been quite turbulent for the markets. So we thought it'd be a good time to explain what all is happening in the markets and to touch upon how do we look at the prospects of the market from now and what we have been doing at Magadh Capital PMS to navigate these turbulent times. So this is all that we are going to discuss today. So in the next 25-30 minutes, we are going to talk about this, and then we can have questions. I'll be very happy to address whatever questions that you might have. So we shall start with some perspectives on the market decline. Then I shall touch upon our view that occasional market dips are actually par for the course. They are a part and parcel of the game. Then we believe that at the current juncture, the markets are at levels that are quite conducive for long-term wealth creation for investors, as long as we have patience. Then we shall touch upon some key snippets of our Magadh Capital's investing framework, including the behavioral angle, on which we have a lot of thrust as a part of our process. Then we'll also talk about our views on some of the macroeconomic drivers that have been gripping the market. Many people have been really concerned with some of these drivers. And to some extent, many of these drivers have contributed to the recent decline in the markets. And finally, we'll talk about what are we doing at Magadh Capital PMS to protect money during these volatile markets and to be prepared for the next market up move whenever it happens. So if we see, obviously the market started correcting sometime in late September, and the Nifty index has fallen by almost 13%. And this has been after a healthy uptick rebound in the month of March. Till end of September, actually, the decline was more pronounced, almost 16-17%. Now, the pain felt by a typical investor has been much more than what is suggested by Nifty 50 index correction. So if one checks the mid-cap and small-cap indices, as on the right-hand side, two charts, one can see that the decline in these two is obviously much more, 19% and 22%. So just to give you a sense, technically, informally, I would say that if the market falls by more than 10% and less than 20%, it is called as a correction. If it falls more than 20%, then informally it's called as a bear market. So definitely there's a discord in the three indices here, because Nifty 50 obviously is more like a correction mode. So in the large caps, the pressure has been much lesser. But in the small cap, if you see, it's more than 20%. Actually, at the end of February, it was almost 24-25%. So obviously, supposedly, it's in a bear market. So, but then we also have to remember that we are still talking just about the indices. So indices tell only one part of the story, because these are average numbers. These are mean weighted average numbers for that particular index. The median numbers, they are much more severe. We'll talk about it later. Before that, I would also want to highlight on how have we tried to look at these numbers and how have we managed to tide over these kind of times. So if you see, we have done fairly well on 1 year performance. We have beaten the benchmark by almost 10% for future stars. That's the mid-cap, small-cap portfolio. For value for growth, that's the multi-cap portfolio. We have beaten it by almost 5%. Since inception, for future stars, we have delivered almost 23% per annum. For value for growth is almost 14.8% per annum. So we are fairly confident about the strength of our investing framework, that it can help us deliver decent performance irrespective of the market cycle that we are in. So if you see, and the better part is that we have managed this kind of performance without taking a cash call. So we have been fully invested all throughout. We are not made too many changes, and we have maintained our exposure to mid caps and small caps wherever we have high conviction. So And the good part is that since we have remained fully invested, whenever the market up move starts, we won't struggle with the timing decision, as in like what is the right time, because we don't get into that decision. And but the best part is that we are more satisfied and happier with the fact that we are able to stick to our framework. So despite all the temptations and the concerns and the potential digressions, we don't move away from our framework. So that gives us confidence regarding future also. Now, if we see another perspective of the decline, the decline has been quite broad-based. So if you see in this one, the orange columns, they are representing the percentage of stocks and the kind of decline that has happened. This is for one particular index, BSE 500 stock index. So basically, there are 500 stocks there, the top 500 market capitalization stocks. So if you see the on the right hand side, the three orange columns, they add up to something like 60%, 31 plus 19% plus 10%. So it means that almost 60% of BSE 500 stocks have fallen by more than 30%, which means more than 30%, probably the average would be 40%. So this is the pain point for investors. And that's why there's sort of blood on the street, as many people love to say that. So many people have suffered really, really big time because of the bigger declines at the median level. So as you go down the market cap curve, many stocks have really suffered big time. Having said that, from our perspective, it's been much better if you see the blue columns. So more than 30% range for us in our portfolio, only about 24% stocks have taken this kind of hit. So that's the reason why, obviously, we are outperforming the benchmark. And now we come to the second part of our presentation. So I would want to take this opportunity to highlight this, that this is not something that we should be really scared of. This is not something that is happening for the first time, or this is not something that is very rare. If you see on the left-hand side, in the last 13, 14 years, there have been so many occasions wherein the markets have declined sharply. But it has never been the case that the market doesn't come back. And typically, it doesn't take too long unless we get caught in a deep and prolonged bear market like 2000 or 2008. And maybe 2020 also. It was not in 2020, around the COVID period, the market had declined by about 37, 38%. But that was not a very prolonged market. So by the time we could blink, it was already out. So, but 2000 and 2008 were really bad periods, about 1.5 years each. In fact, 2000 was 2 years. But apart from that, all these declines, even if they have been deep, the rebound has been quite sharp. So basically, this is a part and parcel of the game, as I was saying. And if you look at mid cap and small cap, the declines are even more pronounced, followed by, again, very sharp rebound. So in case of mid cap, small caps, typically the decline in markets are much deeper and at times longer. They take more time to come back. So here we have collated a list of episodes wherein the markets, BSE Sensex, it fell by more than 10%. So if you see, there are 3 takeaways from this table and chart. On the right-hand side, if you see, there have been 17 episodes wherein the market has fallen by more than 10% in the last 25 years. So one can argue that it's about every 18 months, these kind of episodes happen more than 10%. And a decline of more than 20% happened 7 times in the last 25 years. So which means about every 3.5 years, it's happening. And it is not bunched up in one part of this 25-year period. So it's fairly dispersed. So which means we should be expecting it. We shouldn't be surprised to an extent that we start saying that, no, this is looking very scary. It's a part. It happens. Inevitably, it happens. It will find some reason for a correction to happen. That's the way it works. So only thing is, out of these, if you see, there are 3 rows that we have highlighted. So at Magadh Capital, as a part of our process, what we do is we are not worried too much about these 10, 15% or even 20% correction. We are worried about these bracketed episodes. These are the ones that we try to avoid getting caught into. These are really deep / prolonged bear markets. So you don't want to be caught here because it can take quite some time to come out of that. So now, if you look at the bottom, so right now, after this March rebound, even now, BSE Sensex is down by 12% up from its peak. The median level of all these declines was about 16%. And so basically, half of these incidents saw decline of more than 16%, and the other half, obviously, less than 16%. So we are not very far from there. So we are at a situation wherein generally the probability of a rebound is almost similar to a probability of further decline. But if you adjust it for the deep and prolonged bear markets, 2000, 2008, and 2020, then the numbers look much better, especially on the average side, it's just about 17%, as you can see on the bottom row. So net, what we're saying is that we are at a juncture wherein now the probabilities are turning more in our favor. Second, and the third takeaway that I was talking about, if you see in the last two columns, after these declines, the uptick is quite sharp. So on an average basis, if you see, after these declines in next 12 months, there are only 2 incidents wherein, out of these 17, there are only 2 incidents wherein the 1-year return was less than 15%. You look at the second last column from the right-hand side. Similarly, on a 2-year basis, out of these 17 incidents, there were only 4 incidents wherein the 2-year return was less than 15% per annum. So in that sense, we are fairly placed now, very well placed now. So in my view, after this decline, the valuations are also suggestive that things are looking much better. So of course, 6 months ago also, it was not so dramatic, but once in a while, these kind of declines have to happen. So after this decline, the froth is gone away. So I think the markets are looking interesting. Now, why are we saying, so taking further this argument that we are at a cyclical lift cusp, let's look at the valuation perspective, because just the correction doesn't help, or even getting into a bear market doesn't help. I mean, if fundamentally the markets are not looking good, then probably they can be further decline in place, right? In store. So look at price to earnings and price to book value. These are 2 commonly used metrics to figure out if a market is looking attractive or expensive or reasonably priced. So generally, both the things, both the metrics, price to earnings, PE on the left side, and price to book value, right-hand side, PBV. So both of them can be looked at in context of historical numbers, or at times they are also looked at in context of peer countries, other countries, emerging markets, and developed markets elsewhere. Yeah. So here we have tried to put a chart on the historical numbers for Nifty 50 price to earnings. If you see, we are trading at a reasonable amount of discount. So versus 5-year average, the current P is about 19% discount, 10-year average, 19% discount, 20-year average also is about 9% discount. On the right-hand side, if you see, price to book also is at a substantial discount. So at least Nifty 50 is looking quite reasonably priced, even if not outrightly attractive. And only thing is, Nifty 50, as we all know, consists of 50 largest stocks in Indian markets, right? From the market cap perspective. So we are talking about this obviously has a large cap bias. Let's look at mid cap. What is happening there? So here, as you can see, even after this biggest decline, Nifty mid cap 100 has not become attractive. So except for as compared to 10-year average, probably is not looking too attractive. So in fact, versus 20-year average is still at a big premium. So it means that Nifty mid cap 100 index is not looking too great. So what I want to highlight here that yes, we should be really selective when we are going for mid-cap stocks or small-cap stocks. Only thing is, again, worth highlighting, at least for us, we do not invest in indices as far as stock mid-cap or small-cap stocks go. So, and in our view, these are wider canvases when we talk about small caps, especially because there are 500, 600 stocks in which you can invest in the small cap space. So, which means that even now we feel, and even in the mid cap space, we feel that there's a lot of pockets where you can see value on the table. The upsides are quite handsome, potential upsides, and the margin of safety is quite substantial. Now, we are talking about the cyclical rebound and the potential from here. So look at it from this perspective. The first column on the left. So historically, last 25 years, BSE Sensex return has been about 15%. But if you add a condition that in the preceding 6 months, the return has been negative 10% or worse. And after that, what is the prospective return? So that average works out to 21% per annum. So basically, if you are getting into the market after 10% or worse decline over preceding 6 months, then your chances of making 1-year returns are close to 21%. This number becomes even more interesting if you keep aside the bear markets of 2000 and 2008. So those incidents, if you are keeping aside, then the number looks even better, almost 39%. So these are the kind of, having said that, we must also appreciate that we are not at the bottom. It's very difficult to say that we have reached the bottom, but we are close to that. So as long as we are not getting too greedy, as long as we are not saying that we want to catch it right at the bottom, probably if we get in now, we should be able to reap decent dividends over the next 1 year, 2 years. So this is the potential of cyclical lift. After this kind of a correction, the bets are more in our favor. Now we talk about our investing framework. So obviously we are in a way this keeps evolving, except for the philosophy part, because that doesn't change, but the process does evolve. So in line with whatever we have learned in the last 2-3 years and beyond. So all those things are included here. So now coming to our framework, it is based on two legs. One is the fundamental research and the other one is behavioral finance. So fundamental research is entirely aimed at estimating the fair value of a stock. So whatever we do is somehow designed to try and estimate what is this stock worth that we are considering, right? And then we pick those stocks where the gap between fair value and the stock price is sizable. Then we say that, okay, this is worth considering further. And the research is based on a mix of by dovetailing narratives and numbers, stories and numbers. So stories around, say, sustainable competitive advantages, say, good corporate governance, and the vision and ability of the management. And then we club it with the numbers that we are able to forecast around growth for revenue and good earnings, balance sheet, and the change that is happening from a improvement perspective, or maybe high return ratios or improving return ratios. So all these are aligned to come up with an estimate for a fair value of a stock. Now, as a part of this only, we also have a portfolio construction process that is helping us in diversifying the risks. We call it FACTS, as you can see in the bottom box. So FACTS box portfolio construction process, we call it as. So basically FACTS, these stand for 5 baskets. F stands for fast growers. So basically, these companies are likely to double their earnings in the next 3 to 4 years. So around 20-25% per annum growth is what we expect from that. And typically these are small and mid caps, not in the radar of most of the investors. Very few people know about them, at least not the institutional investors. So the potential for upside can be quite high here, but only one has to be very cautious about the corporate governance and all those issues. So similarly, we have asset plays, A, C for cyclicals, T for turnarounds, and S for stalwarts. So all these 5 baskets, we have pre-assigned ranges of exposure in our portfolio. So we don't exceed or go below those ranges. For example, fast grower bucket in our value for growth approach is supposed to be between 45% and 60%. So we don't exceed 60, we don't put below 45. So basically, even if it's a good stock in that particular category, if that category is already exhausted, we won't be able to take that stock. Now, what does this process do to our to our portfolio? This is what we are able to achieve. So basically, if you see, these are 3 parameters to judge the portfolio for its future prospects. So one is the valuation, price to earning on the left-hand side. Then you have growth in earnings, that is profit after tax growth in the middle. And then you have return on equity. So if you see, it is very well dispersed. So this is what we want to achieve for our portfolio. And this is what we are able to do with our facts box process, portfolio construction process. And that's why we are fairly confident, even in a falling market, we'll be able to outperform the market without taking cash calls. And the second leg of our process, our framework, investing framework, is the behavioral part. So this is in the context of the current markets, we have tried to put some biases that we also suffer from, and generally we hear in the market based on our conversation with people, as like friends, family members, investors. So this is something that is quite pertinent in the current times, and we do it in a proper framework, in a very well documented form. So we are able to avoid these biases. So basically, cognitive biases are biases which prevent us from taking the right decision. Basically, we get emotional about our decision-making process and end up making mistakes. So think about the current times. So after this fall, the valuations have become interesting. Even then, someone who had planned to invest at some point in time, he's just stepping back. Why? Loss aversion, if you see on the top on the left-hand side. So loss aversion is a bias that humans are wired to suffer from. Basically, we all like profits much more. We all hate losses much more than we like profits. So, for example, if someone tells me about a bet wherein I can have a profit of 100 rupees and I can have a loss of 100 rupees, I'll never take whatever be the probabilities of profit versus loss. Basically, I dislike 100 rupees loss 2 times more than I like 100 rupees profit. So in the current context, what is happening is, let's say an investor thinks that 3 years from now, the market will give me 50%, right? 100 rupees will become 150 in 3 years from now. But he's suspecting that the market can go down further 5% if he were to invest today. So because of that fear of that 5% notional short-lived loss, he will not go for that potential up move of 50 rupees. So he's holding on. So this is the kind of bias that holds us back. And at least we have tried to overcome these kind of biases. Similarly, overconfidence. This is another bias that afflicts almost everyone. What? So right now, many people are thinking that, no, I want to wait. I want to wait for the market to come down further. Because I know when essentially, this is based on the belief that when it comes down further, I'll be able to catch that bottom. Now people are forgetting that this is absolutely impossible. I mean, you can ride your luck once in a while, it is possible, but there is no framework to determine the tops and bottoms. Because think about it. I mean, it's called a base rate in psychology, that had it been so easy, no, everyone would be doing it and everyone would be making a lot of money while people work, while people go to offices, because it's very simple. Investing should be like buying at the bottom, selling at the top. Very simple. But this is what is the most difficult part in investing. So that's why we have to accept something that is not, that this thing is not doable. This thing is not forecastable. So we should keep, we should acknowledge our limitation. So this is what overconfidence bias does. Then there is another thing that is scaring us right now. People are really, just about 2 weeks back, people were really scared. People were taking out money. Some people were just had stopped in the ranks, not doing anything at all. What? Recency bias prompts us to think that whatever is happening right now, that's the worst phase of my life. I have never seen worse. So I heard it from a very well-experienced investor. He was saying that I have never seen this kind of a market. Then I reminded him that it's just 2.5 years ago we had seen that. You also were there, right? 2022, 23. It was, in fact, it lasted for 9 months. It was longer than what has happened so far. So, and before that also, as we saw earlier in the presentation, that this happens quite regularly. Or think about it, from a geopolitical perspective, about 2 years ago, people were really concerned that this is the first time after the Second World War that a nuclear-armed country is involved in a full-blown war. So people were saying anything can happen. But look, I mean, 3 years have passed by, and nothing has happened. No nuclear bomb has been dropped. So see, the thing is, we have to appreciate that markets have to cross a wall of worries at any point in time. There are very few periods where there are no concerns. Something or the other will be there. And when there are no concerns, then we should be scared, because that is the period when bull markets, bubbles get created. So when there are concerns, actually, it's a very good sign that people would not get carried away. There'd not be too much of froth in the market. Then one more I'll talk about is getting anchored to wrong figures. So for example, there's a very good stock in our portfolio. One person wanted to talk about that. I told him, why do I like it? But he said that, no, I'm not convinced. Why? Because it has fallen only 9% from the peak, from its September peak. So I want to buy stocks which have fallen 30, 40, 50%. Now, this is a big a cognitive bias that prevents people from making money in the markets. Why? Because you are comparing it to a wrong context. So we should not be looking comparing it to what the 52-week high was or what the 52-week low was. The context should be that this stock right now is at 100 rupees. It fell down from 110, but it is worth 250. So in next 4 years, probably it'll go up to 250. I should be comparing it to 250. I should be saying that it's available at its discount of 60%. The upside is 150% from here, instead of thinking that it's fallen only 9% from the peak. So these are the kind of things that matter. One more thing, authority bias. So many people are taking a call on the basis of what they watch on business news channels, or maybe what influencers are saying. So basically what happens is that just because that person is on TV or he's having such a big fan following, so we think that, okay, he must be knowing something. He must be having that authority. So he can get away with whatever. So whenever he says that, no, 31 days from now, the market bottom will happen, so I'll wait for 31 days. So these are the kind of issues that crop up, and we try to avoid. At Magadh Capital PMS, we never, at least we try to avoid most of the biases that are very common. Think about portfolio decline. See, the way to look at it is that decline in portfolio is not equal to a decline in wealth, as long as I become jittery and book the losses. So these declines are temporary, they are notional, they are short-term. So eventually they come back. Only thing is, one must be sure that the kind of stocks that are there in the portfolio, they have to be impeccable. And especially the portfolio, the entire portfolio, the kind of diversification that I've imparted to the portfolio. So finally, this is sort of bottom line for, at least in one perspective, that market timing is not possible. So why to try doing that? Had I been able to do that, it would have been good, right? It would have brought me to perfection, but it's not possible. So it's futile. Let's try to do something that is equally potent in terms of long-term wealth creation potential. Then some views on top-down macro drivers. So if you see, these are some of the issues that have propped their head in the last 6 months. And at various points in time, these are the issues that have hindered the market's movement. In fact, they have pushed it down. So in the last 2 months, obviously, we have seen a lot of rhetoric on the tariffs that the USA is going to impose. Very briefly, our view is that India probably should be one of the least impacted countries. India is having a very low dependence on trade as a percentage of GDP. We are more a consumption-led economy. We are also trying to develop manufacturing and investing. Trade, somehow we have not been able to do much. So, and in fact, this is an opportunity for us, this in a way that is being forced down our throat. What? The rationalization of tariffs. Our tariffs were out of sync, absolutely out of sync with the developed world or even with the emerging markets. So that's why we used to struggle to get into any multilateral trade treaty. Even bilateral treaties where agreements were not easy for us to settle because of this only. So hopefully this should be leading to a good outcome, actually, this pressure on the tariffs. And in any case, at the bottom line level, if you see, the new USA regime has been much more severe and has been much more aggressive against most other large trading blocs and countries. So with India, they have been relatively less combative. So let's see how does the outcome go. But at the same time, I would be less concerned about this in terms of final outcome. Currency, yes, US dollar has started weakening. I would say it would be good if for some time US dollar weakens. From India's perspective, monetary policy is moving in the right direction. Government capex last year had really dwindled, so as to say. It had disappointed a lot even after the elections were over. For 6 months almost, the government capex continued at a very low level. So practically there was no growth. But now, and that has been a big driver for India's economic growth in the last 3 years. So last year it was missing. Last year, as in like the fiscal year 25. So next year, again, there are signs that it should improve. And the government also has come up with a decent target. So I think that over the next 3-4 years, we should be expecting 12-13% per annum. And this should again lift up the investing side of the economy. Fiscal policy, again, the government has been very disciplined. So that is one of the positive points so far. Even in the last 6 months, on this front, no economist has been complaining much. I think the government's balance sheets are looking very strong in terms of the trends from here. And finally, what does it translate into economic growth? So I would say that the fastest growing economy tag should continue to stick to India. So 6 to 7% growth should be expected for the foreseeable period. So I think that is not going to change. Then one more thing that has taken a toll on India's stock markets has been the corporate earnings. So Nifty 50's earnings growth, those companies that form from the Nifty 50, their earnings growth in fiscal 25 will be quite sluggish, not more than say 6%. So versus 13-14% that had been achieved in fiscal 23-24. So that was a big disappointing factor for the markets. What we are expecting is next year, fiscal 26, they should improve. And FII flow has been detrimental. So that also has some change in store. I'll show you. So this is about the government capex, if you see. So fiscal 26, it should improve. Corporate earnings, last 20 odd years, the increase has been 11% per annum. So fiscal 25 will be quite poor, quite depressed. But 26 again should be a rebound. So that should lift the markets in our view. And this is about the FII flows. If you see on the left-hand side, all these periods of FII outflows have been followed by equally strong inflows, except for 1 or 2 occasions. So generally, after some time, this also is a very cyclical thing. So for example, for some 2, 3, 4 months, people have been saying that China has become more attractive. So yes, it'll go, and it has gone. But beyond a point, just like portfolio managers try to keep diversification in their portfolio, similarly, foreign investors also want to diversify. They would not want to be concentrated into one country. So at some point in time, they should start coming back. I don't know how, when, but it has to happen at some point in time. It will happen in the future, always in the history. Finally, what are we doing? So the first and underlying thing is our assessment. We believe that it's highly unlikely that we'll see a bear market like in 2000, 2008, or even 2020. So what our action and thought process are as per our general routine, as in like it's business as usual for us. So we are not perturbed. We have not changed our portfolio at all. I mean, unless it is required by normal business requirements, as in like our normal thought process. So nothing, we haven't made any change on large cap, mid cap, small cap and all. So it's just business as usual for us. What are we doing is that we keep analyzing portfolio stocks. We keep looking for flaws in our arguments. We keep looking for alternative scenarios. We keep reassessing what can go wrong, etc. So these are things that we do even otherwise, whether in bear market or bull market. So it doesn't change. And third thing is we are fully invested, as we have been all along. So we didn't feel the reason, as I said, because we don't expect a deep and prolonged bear market. So and whatever funds that we are getting now, we are deploying it quickly. So from new and existing investors. And in our view, this is a good time to invest, not because the markets have corrected, but because we see that the medium-term prospects of Indian markets are rock solid. So I'll stop here. So I'll be happy to address any questions.
Hi, Vipul.
Hi.
Thank you so much for the amazing presentation. One of the things which we are hearing still a lot is people are still saying that while Nifty 50 is in a good zone, mid cap and small cap are still reasonably above the long-term averages. So to that extent, do you think still a good time? I know this goes back to your bottom of the market thing, but at least the narrative is that mid cap and small cap are still reasonably high from long-term averages.
Manish, so absolutely agree with you. If you see this chart, I hope you can see this chart.
Oh, not one sec. Yes, I can. Sorry.
Yeah. So I was saying that, so there's nothing denying that even after this sharpish correction, or more than 20% correction for mid caps and small caps, they are at a sizable premium to historical averages, no doubt about that. But having said that, I would also want to highlight that mid caps and small caps, you don't invest via indices generally. You have to do indexing, right? So, and especially the small cap canvas is so wide, you have 500, 600 stocks. So there are some gems hidden within that, even within the mid caps. So mid caps is about 150 stocks. You have some stocks that are indicating very strong upside without much of risk. So basically what we are saying is that you still have many stocks which are showing a lot of money on the table. And there's no dearth of such opportunities, even in mid caps. In small caps, you have many more. It's only a question of you're being able to do that kind of hard work. Because in case of, obviously, in large caps, the information flow is so high that you can't go wrong. The probability of you going wrong is lesser on large caps, wrong from a corporate governance perspective. In small caps, those risks are there. So that's why that if you are going for that, you have to be very selective and you have to do some basic groundwork. But coming back, in our view, there are some good opportunities in mid caps and small caps also.
Sure. Thank you. if nobody is asking the questions, let me pile on again. So you believe that there are enough small and mid cap which are available below their intrinsic value, forget the long term short, the average indices.
Can you repeat, Manish?
I'm saying, so in a nutshell, you believe that there are enough and more small and mid cap that are they're available below their intrinsic value.
Yeah, there are actually lots of them. So see, the way it works is in small cap and mid caps, at times there are a lot of excesses that get built into the system.
Yeah.
They really become real hot stocks in hot sectors, in hot spaces, right? So a majority of them become in that category because everyone wants to jump onto the bandwagon. Everyone wants to make some quick bucks, and that's the way to do it, right? So in first half of 2024, if you're not in small caps, then probably you were doing a disservice to your family, right? So once that froth is going away, and still at the index level, that froth is still there. But having said that, there are some stocks which are not getting that kind of attention. And those are the stocks which you would want to study in more detail. Those are the stocks where probably you can get the upside. And there are many stocks like that, and not in one particular sector, across sectors. There are many stocks that have not yet got the investor attention and which are doing an amazing job from a corporate governance perspective. They are superb, and still, just because they are small, they have not got the institutional attention, the media attention. So it's there actually. But only thing is, one has to have very grounded expectation. So if one thinks that just because I'm investing in small caps and mid caps, my money should double in 2 years, probably that's unlikely to happen.
You don't have any worry on SIP flows? Right now they're holding up, but is there any concern or risk that they might get hit?
See, in the shorter term, yes, because that also is going to be cyclical, right? At some point in time, people will start, the stoppages of SIP will start exceeding the new SIP. So far, they've maintained about, they've kept on going only, probably they're 26,000 crore a month. But at some point in time, they'll happen. But this will be more like a cyclical part. The structural part of the story is financialization. So if we are able to look at it in, say, buckets of 3, 4, 5 years, so every 5 years is going to go up further from here, because all along Indian households have been investing disproportionately higher in real estate or even in gold. So that, and many people even are big time, even in urban areas, in fixed deposits. So people are realizing that you have to diversify it. It's not that equities are always better than fixed deposit, right? So it also depends on the specific situation for that individual. But at the same time, diversification is required. We still see that the exposure to equities are very low. So, and people are realizing, especially the younger generation, and even the retirees now are have more information at their disposal. So that way it's changing. So I'd not be too worried, but yeah, one round of cyclical downturn can happen, and probably it may, who knows, maybe 6 months, 12 months, it might happen, depending on the market correction. If, let's say, market corrects again by 10% or 15% and stays like that for another 6 months, then I agree with you that it has to happen. But at the same time, one more angle we have to remember, if you look at the FII outflows, so for the last 9-10 months, they have been relentlessly selling, right? As a group, the FIIs. So at some point in time, that also has to reverse. And that when it reverses, so probably it'll come in our favor. So, but that, one more thing I want to say, that this is the liquidity side of the markets. So this is not the fundamentals, right? We all know that this is flow, and they do play a very big role, as in like how much money is coming in or is going out. But eventually, longer term, the fundamentals will prevail. Oh.
Hello.
Yeah, just one moment. Yeah, Amit.
Yeah, so, Vipul, can you hear me? Am I audible, hopefully?
Yeah.
So, Vipul, thanks. I think this is a very insightful you've given in your presentation. I had one very small question, was that in your portfolio of 40-45 companies, how are you the risk within your portfolio. For example, some of the portfolio companies would be performing. Obviously, they would not. They would be performing less, or some may be performing higher, and there would be an intra-portfolio risk, which would, given the macroeconomic situation, how it will turn in the next 6-7 months, tend to drag the overall portfolio return. So, how are you looking at that part, managing that part?
I missed one part of your question, Amit. Can you please repeat this one?
So, Vipul, what I was saying is that in your 40-45 companies that you have,
Yeah.
The risk within your portfolio, within the 40-45 companies would be different. So there would be certain part of your portfolio where the risk would be higher. And of course, that is a risk that you are taking consciously. Now, there could be a possibility of that risk dragging down the portfolio return. So how are you mitigating that part?
So see, what we try to do is we try to do proper mix and match, proper diversification. So what we try to ensure is that not all the companies will move at the same time. And in terms of various parameters, they are at different stages. So if you see, for example, in the current phase, which are the companies that are more vulnerable? Companies that are highly leveraged, companies who have invested a lot in the last 3 years, but they are not yet ready with the new gross block, new fixed the, plant and machinery, who have not been able to capitalize those assets. The assets are still lying as capital work in progress. So basically, they're unproductive assets. They have deployed money, but it's not yet ready, right? Or maybe some companies who have been running very high inventories, working capital, right? But so these are the more vulnerable ones. Some companies who have taken big projects, but they have not been able to upgrade their ability to execute those projects. So I'm all giving these examples from our portfolio only. But on the other hand, there are some, and we have done it deliberately. On the other extreme, there are companies that are done, that are ready with their capex, and they are at in a very sweet spot. The market is also lifting up. The market is growing very fast. So their cash flows are really more than a handful, right? So those companies are doing very well. So for us, what matters is the portfolio return, right? If we are able to tide through this volatile phase, then we'll be fine after some time. So what we need to do is, some companies will fall much more and they'll be vulnerable also. But we also need to have some companies where the balance sheets are prim and proper, where they are getting very good growth, whose return ratios are absolutely impeccable. So this kind of mixing, this kind of diversification is helping us hold it up. And that's why we are beating the market. And as I say, without taking much risk. Because having said that, even the companies which I was talking about that seem more vulnerable right now, even they are very good prospects from a long-term perspective, because we can see the improvement in their return ratios. We can see the growth pick up very solidly, very handsomely. But it may take some, we are maybe 2 quarters away from that thing. So we don't want to sell it and then get in, because that's very difficult to time. So that's the way we are doing it. I hope it answers you.
Yeah, people, thank you so much. I think that clears the point. It's basically where these companies are in terms of their business cycle and the
Exactly. Yeah.
and how we are looking at the. So one very quick small question, Vipul. Sorry, I understand other people are also on the line. So our PMS returns, when you look at from the performance of PMSs, other PMSs in the market, I have not seen the report where it is, at what level is it. So you were talking about behavioral finance. At any point of time, do you think of uh, benchmarking yourself with the ones who are doing the best, or who are better than you, and trying to match their returns? Is that also a very deliberate, conscious call in terms of your the strategy that you are using for choosing companies in your portfolio? Do you get affected by that, or you are just going with a philosophy and reaching where you are, reaching in the normal?
Okay. I'll tell you one thing, some data. So we do look at it. So on APME website, APME is like AMFI. AMFI is like Association of Mutual Funds of India. That's the agency that has been set up by SEBI to take care of mutual funds. So I was saying that APME is Association of Portfolio Managers of India. So they collate and give out all these data on their website, APME. It's a very good data, very good website. So very good interactive database they have. Now, on that one, if you see, as on 28th February, on 1 year performance, we were at close to top 6% of all the PMSs. On 2 year performance, we were in the top 2% of the PMSs. 3 year performance, we are in the top 3% of all the PMSs, 1,000 schemes that are there in India and PMSs. So we are doing fairly well. But having said that, and we do look at it at times, right? But to be honest, we don't really care much about it. What we try to do is, when we come to office every day, when we are meeting a company, when we are working on a company, we are just focused on fine-tuning our call and our portfolio correlation, right? That's the only thing that we are aiming to achieve. And the thing is, if we have to compete against something, it's the benchmark. So we do try to beat the benchmark, and we do try to beat the benchmark handsomely. But to be honest, as I said, we don't look at others much. And we do see that some people are doing much better than us also. And we are, as I said, we are one of the best in the amongst all the Indian PMSs. But there are some who are ahead of us also. But we don't look at their portfolio. We don't need to, because we are very happy with our own framework. And we know what we are doing. So we are very comfortable with that. We are able to sleep peacefully. And we don't get stressed out about anything. And we also agree that at times we'll not be able to maintain this ranking of 2% and 3%, maybe, right? But as long as we are beating the market consistently, we'll be fine over the long term.
Thanks, Vipul. Thank you for clarifying. Thank you.
Thanks, Amit.
Hi, Vipul.
Hi,
Thank
Vinay.
you for your great presentation, very insightful. Just a quick question. How do you see the impact of FIIs versus domestic investments? Because if the recent declines, are they all driven by FIIs kind of exiting or kind of, minimizing the exposure, or is it also the domestic, investors, withdrawing?
So see, so this is the liquidity part of the market, right? So, and liquidity does play a big role, but eventually, as answering to Manish, that eventually fundamentals take center stage. Eventually, liquidity follows fundamentals. But there can be periods of 1 year, 2 years, or even 3 years wherein liquidity is driving it all, right? So fundamentals have to take the backstage. So right now, I would not say that the FII outflow has caused the market correction. I would say that yes, both of them have happened together. And to some extent, yes, the market outlook has dampened also because of the FII outmove, because it becomes a big media thing. So TV channels start talking about the FII outflow and all that. But there are some data points that we can look at. One, the importance of FIIs has reduced in the last, say, 15, 20 years. FII used to be the biggest chunk of holders in Indian equities. That has gone down now. But to think that they don't matter would be incorrect, would be too naive. But also one thing that I am at times puzzled about, why do people think about FII as one single entity? So what I love talking about, when I talk about FIIs, I think it's not that every morning they sit on a round table and then they decide today we are going to sell and today we are going to buy, right? So FIIs are of different hues: hedge funds, pension funds, long-only mutual funds, sovereign wealth funds. So they all have, and private equities, which invest in public markets. So they all have their own models, right? So for example, in the current round, it said that hedge funds have been the biggest sellers. In fact, pension funds have not sold at all. Sovereign wealth funds have sold to some extent. So these are all very different. Just because they have that FII tag, just because those numbers are visible on RBI, it doesn't mean everyone is behaving the same way, right? Because these are all different managers. So even within the domestic funds, some fund is selling, some fund is buying the same stock. So only thing is, because of their categorization, we also say that, okay, all the FIs are behaving like that. But yes, For argument's sake, one must agree that yes, if you put the FII data together, it's a fact that it's been an outflow. So coming back to your thing that, and it has happened. I mean, it does matter. It does impact the markets. From my perspective, I also believe that these liquidity events are often cyclical. So the Indian markets, Indian domestic institutions, they would not be directly cyclical. Why? As long as they are getting money from investors, retail investors or HNI investors, they will continue to invest, right? If I put money in a mutual fund, he won't be able to sit on that cash for long. He'll immediately invest, right? So he won't take cash calls. So domestics will continue as long as these SIPs are continuing. But the FIIs take their own calls because they have other options also. Only one big change, apart from the reduction of FII's importance in India, another important change that has happened in India is that earlier, India would attract money only from India dedicated funds or partially from emerging market funds. Now, within MSCI emerging markets, India's proportion has gone up to 20-21%, all very close to what China is at 23%. So emerging market funds are also investing big time in India. Dedicated funds obviously are investing, and then some global funds are also starting to invest because of the size increase. Right now we are 5 trillion market cap economy. 10 years ago, probably we were at 1.5. So that way it's changing. But coming back, FII flow can also be looked at as cyclically. So that's what I was saying, that domestics cannot be cyclical because it will depend on the investor psyche at the ground level. But FII flows can be cyclical and it has always been like that. I've shown a chart that every big outflow is followed by at least a decent inflow period.
Great. Thank you.
Thanks.
Hello.
Yeah. Hi, Kushal.
Hi. So I was listening and it was very insightful, everything. And there's a lot of discussion on FII. I'll be taking 2 minutes. I have some general 2-3 queries, general in nature. So FII is interesting. I just was going through yesterday's data. They bought about 7,200 odd crores and DII sold 3,200 crores something.
Yeah.
So where on a lighter note, where DIs were waiting for FIs to start buying heavily when they start pressing the F2 button, that was on a lighter note. So for last 6-7 months, as you told, they have been selling relentlessly FIIs. So can it be seen this heavy buying yesterday, which we saw, I think after many days, I think. Will it continue the same way, or we can see them again starting the sell-off? Because if I am not wrong, when we were at a peak Indian market, China were at a multi-year low, China indexes and stocks.
Yeah.
And now with US markets still heated up, the inflation is still not going. Last Fed they have kept it unchanged, their interest rate. So is it likely that the funds may still keep going back to US or to China, and whether we'll be seeing next 2-3 years flows, consistent flows of FIIs? That is one. And second is we'll also be slowing down India next 2-3 years. Our inflation is coming down, so probably we'll be facing some challenges for our own GDP overall macro perspective. So on these perspective where US and China looks more attractive and we'll be slowing down next 2-3 years, how competitive our market will be and how will be our returns. And another thing is there any scope of government relaxing an LTCG at least to some extent? I think the LTCG contribution will not be even 5% of the total cash receipts. So is there any chance of seeing that may give an immediate boost to the market? So are you looking at any changes to this? Because if I don't know among all the developed equity markets, which market imposes both short-term and long-term capital gains? whether we are the only one or is there any other country also. So if you can just let us know about on these points.
Yeah. So I'll start with the last one. So
Yeah.
we did some basic work on LTCG. So actually, LTCG for domestic investors is there is there in almost all developed markets. All democracies charge that generally. But LTCG on FIIs is something that no one does that. No one does. So that is where we are standing out, and that at times is being taken as a big handicap for Indian market as far as foreign money is concerned. So that argument that if you are making, let's say, last 25 years, last 20 years, the BSE Sensex has been last 15 years, 12-13% return. Out of that, once you charge 15% capital gains, then you lose 3% and then 3% on rupee depreciation. There's not much left on the table for someone, right? So that argument sounds very strong in my view. And since no one is doing, personally, I feel LTCG is, I mean, we can discuss it later also, but yeah, LTCG is a good tax. It is a required tax. Otherwise, inequalities can increase in the system. But you also have to do whatever everyone else is doing, right? In Rome, you have to do as Romans do. So everyone else is not charging LTCG on FIIs. You continue to charge. That is a handicap. So as long as everything was fine, you were small, no one would bother much, it was fine. But now you are in the limelight because now you are big. So people will ask these questions. So I don't know if the government is going to change that. Generally, if you see the government doesn't respond to lobbying on the taxation. So, but I'm sure they will be considering, they will be looking at it from every perspective. So I don't know what they're going to do. But in my view, if no other country is charging it, we should also consider, in my view, personally, I would say. So that's one part. And then you were, I forgot the other question, but yeah.
FIIs,
So,
FIIs. FIIs flows.
Yeah. So see, US, in my view, again, I'm not an expert on that. I just read newspapers. But in US, it looks like it's a bit of a distortion that has crept up in the markets. So top seven are still, it's still a very top heavy market, right? So if the valuations come under a question mark for those top seven companies, and if the earnings growth start getting into the sluggish territory, then probably there can be some correction. And in any case, there the money has been going predominantly into those stocks. So that is one concern that people might have about the US, and US valuations are really literally into the stratosphere. So that is something that many people might consider. Having said that, despite all these concerns, US markets have been able to defy, in fact, all these concerns so far. Regarding China, yes, probably they're coming back and getting their own limelight after a long time, Chinese markets, because for last 15, 16 years, they had been really languishing. So, but my point is that it doesn't have to be either US plus China or India, right? So even though you would say ultimately it's a zero-sum game as far as liquidity is concerned, but remember one thing, that India also attracts investment not just because US and China become inferior. India has to attract investment because India's prospects are good. So there are many things that go into India's favor, including the improvement in infrastructure, including demographics, including improving disposable incomes, and this being the only country where population is rising. So yeah. So that I hope I answered your question.
Yeah. Thank you.
Yeah, thanks.
मेरे को बुलाया क्या? तो फिर
So do we have any more questions? Okay, so that's it from our end. Thanks a lot for joining in, and we'll be in touch. If you have any questions, do yeah. Okay, so thanks a lot. Bye-bye.
Thanks a lot.